Good afternoon to everyone. I'd like to begin with a prayer from the New Zealand prayer book that I think is particularly fitting in light of our conversation today about environmental, social, and governance issues. Let us pray. God of unchangeable power, when you fashioned the world, the morning stars sang together, and the host of heaven shouted for joy. Open eyes to the wonders of creation, and teach us to use all things for good. Honor of your glorious. Amen. I'd now like to introduce our moderator, Mary Kate Wold, who is the CEO and president of the Church Pension Group. Mary Kate has served in this role for over a decade, and prior to joining CPG in 2011, she held a number of leadership positions in the corporate, legal, and governmental sectors, including at one of the world's largest research-based pharmaceutical companies, at a leading global law firm, and at the United States Department of the Treasury. We are all so grateful for Mary Kate's steadfast leadership here at CPG. Mary Kate, over to you.
Thank you, Patrick. Well, welcome everybody. We're delighted to have you today. We have a short hour with a lot of content, and I hope you find this very stimulating. This is one of a series of programs that we've branded Insights and Ideas, with the primary focus being socially responsible investing. And our goal is to bring ideas and concepts to the church and beyond to help people think about the importance of socially responsible investing and how one might pursue these concepts in their own investing, whether it's as individuals or large institutions or possibly even smaller institutions. We are really blessed at CPG to work with some extraordinary partners in a variety of capacities. And we also use these occasions to really highlight some of the amazing people with whom we work. And we have three of those individuals representing three organizations where we have deep relationships with us today. And I'm really thrilled to be introducing them to you. We have at CPG a very proactive strategy in socially responsible investing that I'm very enthusiastic about and very proud of. And it really has four prongs. The first prong is what we call impact investing, where we're actively looking for investments that have a social or environmental positive impact in the world, in addition to producing the returns that we have to produce as a pension fund. The second is what we call shareholder engagement, and that's where, especially with public companies in our portfolio, we interact with those companies on certain issues to encourage them to align with the values of the Episcopal Church. And we join with those efforts with other faith-based investors and mission-focused investors, as well as the CCSR committee of the Episcopal Church. The third area of focus for us, the third prong of our strategy, is what we call ESG incorporation. And that's thinking across the portfolio as we do due diligence on managers, as we interact with managers with whom we invest, to where it's material to really consider environmental, social, and governance issues. And then lastly, thought leadership. This is an example of thought leadership, but it ranges from programs like this, where we bring thought leaders in front of leadership in the church to help spread the good news about socially responsible investing, to interacting with peer organizations and trying to increase the capital that is devoted to these good causes. So today, the conversation is going to focus specifically on ESG, environmental, social, and governance issues, and the role in that plays in investment portfolios. Some of the issues that we'll talk about, or questions we'll review, are: what do we really mean by the terminology? How does ESG fit in an investment approach? What ESG issues are most important? What are the different types of approaches that investors take? And how can even individual investors incorporate this in their own investment strategy and philosophy? So as I mentioned, we have three really fantastic panelists from outside the organization today, and one of our own as well. And their lengthier bios are on the website, but I want to say a few comments about their really extraordinary backgrounds. And the first person to whom I'll introduce you is Jonathan Bailey. Jonathan's joining us from London. And I should say we have a very global panel today. Emily is joining from Chicago, Jonathan from London, and Jacqui from Australia. And then the rest of us are sitting here in New York, but we're basically spanning the globe today. Jonathan is a managing director and head of ESG investing at Neuberger Berman, which is a private, independent, employee-owned investment manager that's been around since 1939. That's real staying power in this industry. And Neuberger Berman provides one of the options that we have in our clergy and lay employee defined contribution plan. So if you're in those plans, certainly make that connection. Jonathan joined Neuberger Berman in 2017, and he works with portfolio managers and analysts to enhance existing ESG strategies and to launch new ESG and impact investing strategies at the firm. Prior to Neuberger Berman, he spent most of his career at McKinsey. He also worked for Generation Investment Management, a firm that was co-founded by Al Gore, our former vice president, and David Blood. And then he also worked on governance projects for former British Prime Minister Tony Blair. Jonathan has a variety of advanced degrees, including from Harvard Business School, from the Harvard Kennedy School of Government, and from Oxford University. Next, I'd like to introduce Emily Lawrence. And Emily, as I said, is joining us from Chicago. She's with Northern Trust Asset Management, and we have deep relationships across a variety of functions with Northern Trust, including them acting as a custodian for a good portion of our financial assets. Emily serves as the North American Director of Sustainable Investing Client Engagement at Northern Trust Asset Management. She's responsible for client engagement and partnerships regarding their sustainable investing capabilities. She's an active member of the Northern Trust Sustainable Investing Council, their proxy voting committee, and their executive corporate social responsibility council. Prior to joining Northern Trust, Emily also worked at Morgan Stanley and KLD. She also has an illustrious academic background. She received a master's in international conflict resolution from the Institut Catholique de Paris. Didn't quite pronounce that correctly, probably. Another master's in European politics and governance from the London School of Economics. And she holds a BA in French language and literature from the University of New Hampshire. And then from Australia is Jacqui Murray. Jacqui works with Resource Capital Funds, which is a mining-focused private equity fund. And I should note that CPG, we get this question often, we never invest directly in companies. We won't buy stock of an individual company. We don't invest in an individual real estate project. We always invest with trusted managers who are elite in what they do and what their focus is. So one example is Resource Capital Funds, which is a mining-focused private equity fund. And Jacqui is an investment team leader with whom we work at that fund. We've invested with them for over a decade, and Jacqui oversees due diligence of potential investments in mining companies and also actively manages their relationships with existing portfolio companies. She's also a member of the firm's ESG committee. Jacqui joined Resource Capital Funds in 2012 after working in various geotechnical engineering roles in underground and open pit mining operations with BHP Billiton and WMC Resources. And I'd just like to say here, you know, it's unfortunate, but we don't have a lot of women investors in private equity firms. So Jacqui is unique in that regard, but I think she's extremely unique in the mining industry because as few women investors as there are, you know, relatively in private equity firms, there are probably even fewer women working as in engineering capacities in the mining industry. So we're really thrilled that that Jacqui is a trailblazer there. And she said there, we had this conversation earlier, she said there more and more, but it's still a relatively small percentage. Jacqui too has a variety of academic credentials. She has an MBA from the Melbourne Business School and a Bachelor of Geological Engineering from RMIT University. She's also a graduate of the Australian Institute of Company Directors and serves on the board of directors of Alliance Mining Commodities and Technology Metals Australia. So again, Jacqui, thank you for joining us in the wee hours of the morning. We'll hope that this conversation is lively and keeps you awake and engaged. Lastly, I want to introduce our own Christopher Rowe. If you've been attending these Insights and Ideas panels, you've seen Christopher playing a leading role on many occasions, or usually. Christopher is a managing director on our investment team. He's the lead person on our socially responsible investing engagement strategy and outreach initiatives. Prior to CPG, Christopher held leadership roles at Prudential Financial, including with respect to sustainability. Earlier in his career, he worked directly with institutions and faith-based investors on strategies to integrate values with investments. Christopher received a BA in economics from Haverford College and an MBA in finance from NYU University, and he's a chartered financial analyst. So with this well-credentialed panel, I'm going to jump in and start the conversation moving. And Jonathan, I'm going to start with you. There are just a lot of terms, and I've used them already. ESG, impact investing, SRI. So today's focus is going to be on ESG. With all of these terms swirling around, can you focus us on ESG and tell us what that really means in the sustainable, and there's another one, sustainable investing, the sustainable investing world?
Yeah, happy to. And it's really nice to be with everybody today. I acknowledge that one of the failures perhaps of this industry is using lots of acronyms and lots of terms. So hopefully I can clear up a little bit of that now. The way that we think about it is that environmental, social, and governance considerations, ESG considerations, are a group of things that might be financially material to how a company or a stock or a bond might perform. And that considering those ESG factors in an investment decision is part of good investment discipline. And the reason why we need to kind of give them a name and call them out is that if we're honest, if you go back a decade or more, too many investors weren't looking at topics like how a company might be affected by climate change, or whether they had strong diversity policies, or even if the executive compensation plan was rewarding management for the right things. And so we've called them out and used the acronym ESG to make sure that we're giving appropriate attention and focus on these topics. But it's not to say that ESG investing is solving only for ESG, right? They are factors that you consider alongside more traditional things like how much debt does the company have? Does it have good products? Is the management team competent? So these ESG factors in ESG investing are no more significant than other factors. And you put all this information together in order to get a much more holistic assessment of the risks and opportunities that you as the investor have when deciding whether or not to own that company, that stock, that bond. And that's fully consistent with the fiduciary responsibilities that a manager has to a client, that a trustee or a board member has to those that are investing in a fund. Now, that is a little bit different than what you might look for in an impact strategy. And you already kind of mentioned impact, right? Where you're looking not only for financial return, but you're actually looking intentionally to generate positive social or environmental outcomes for the planet, for people, alongside that financial return. So in an impact strategy, you you are thinking about environmental and social issues, but you're giving that a much more significant weight, and you are trying to achieve multiple outcomes, financial and social and environmental, through your investment decisions. And somewhere in between, we think sustainable sits. And that's saying that you can use an analysis of sustainability considerations to identify companies that are true leaders in innovating around sustainability trends, right? So these are the companies that we think might be the winners of the future because they are developing the solutions to many of the challenges that we have. So for example, think about a company like Microsoft, right? They are radically decarbonizing their business model, right? They've actually committed to taking out of the atmosphere all of the carbon that they've ever generated in their whole history. They're also doing some great things around creating diversity, inclusion, and equity within a sector, technology, that hasn't always been so great at that. So we would think of them as a company that's quite a sustainable company because of the way that they run their business. And hopefully, right, that leads to strong financial performance. So if I sort of summarize it, ESG integration is assessing ES&G factors alongside all those traditional investment considerations. Sustainable investing is finding those true leaders on those sustainability characteristics. And impact investing is seeking to achieve social or environmental positive outcomes alongside the financial return. And if you think about a funnel, ESG integration gives you lots and lots of things to invest in. Sustainable gives you slightly fewer things to invest in because sadly there's not that many leaders. And impact investing probably gives you even fewer opportunities. And so that's going to change the risk return profile and the types of opportunities that you've got. But all have their place and all are interesting for different investment portfolios and different considerations.
Oh, that's an excellent foundational explanation. Thank you. And you mentioned materiality when you talked about ESG. So I think oftentimes, usually, always, when investors are looking at ESG considerations, the question is, are they material to the investment decision? So I'd like to ask Emily and then Jacqui how they think about materiality, and then we'll go to Christopher as well, and how you think about materiality of ESG factors when you're looking at investments.
Thanks, Mary Kate, and thanks for having me here today. So jumping off of Jonathan's great foundation of identifying ESG issues as business issues, you're very right. We want to focus in on what is material from an investment perspective. We turn to an organization it used to be called SASB, the Sustainable Accounting Standards Board. It's now called the ISSB, the International Sustainable Standards Board, which is an independent nonprofit organization that produces investment research, essentially, that is evidence-based. It's focused on defining what are the ESG issues that are material for a given sector. And I use the word material intentionally here because we're talking about investment decision useful information. And this is important for a couple of reasons. One is we can take a cue from this framework, this materiality map, to root our assessment of what is truly material. We as investors can feed into that materiality map. So Northern Trust Asset Management, for example, participates in the investor advisory group for SASB that helps drive the consideration and the thought process behind their materiality map. And then we can use this assessment also to prioritize topics for engagement activities. Where do we want to see better disclosure, better information that's clear and consistent and comparable for decision useful insights and so on. So, as we're talking about materiality, I think Jonathan's point here of ESG issues are part of a complement to traditional investment analytics, so we can build long-term, more resilient portfolios. We have to root our assessment in this materiality lens so that we can make really thoughtful investment risk-aware decisions. So as we're thinking about materiality, we're really leaning on the SASB mapping as the sort of an international standard. And it's really encouraging, as I mentioned, their name has changed because they have taken on a more global role. So landing under the umbrella of the IFRS, I see not just investors turning to SASB, the materiality map as that definition, but we also see regulators and other bodies looking to that organization as a standard setter. So we tend to lean there as we're talking about how do we define materiality.
Great, thank you.
If I might just hop in there, Emily, I really very much appreciate your bringing in the international standards to the conversation. And one piece about this that I think is definitely relevant for our audience is to think about materiality and the extent to which, the information that we're using is actually relevant to an investment decision. The international bodies that actually establish these materiality frameworks consist of asset owners, asset managers, and companies to work through the elements of what is meaningful in an investment decision and what is not. And I think that's important for us all to understand, because there are some out there who look at ESG investing generically and say, well, you're focusing on non-financial issues. Well, no, we're not focusing on non-financial issues. ESG issues are financial issues, and as any investor, whether it's as Jonathan mentioned, if earnings growth is important, if environmental opportunities and risks are important, if human rights are important, they should be considered in the context of investment analysis, and they're certainly not non-financial.
Excellent. And Jacqui, I'm sure you go through that analysis as you're looking at potential companies to include in your investment portfolio.
Yeah, exactly. And I think the other people have highlighted many of the things we look at in terms of which standard will you use, and how will you measure. I think to give a real specific example, it is quite difficult, and it does change depending on what you're looking at. And the example I'd give is a mine in Chile will have a very different level of materiality around water than a mine in another region, say Canada. And so, and when we're looking in Africa, we might be much more concerned around impacts on biodiversity. And so it really does, it's very local. And so I think Emily spoke about very industry specific tests for materiality. We find even within our industry, then the specifics about an investment, where it is in the world, what type of mine it is, whether it's mining on the surface or mining underground, will have different potential impacts and then different levels of materiality assigned to that. And how do we assess, what is the right materiality? I think it's a significant amount of experience and looking in the trends of industry, and where have things gone right and where have things gone wrong over time. And over time, you do develop benchmarks of what you expect to see in each area for these specific issues or concerns we might have.
Thank you. So you alluded to fiduciary duty, Jonathan, and ESG has been in the news a lot recently, but taking some criticism from many sides of the political spectrum. So there have been criticisms that ESG in and of itself violates fiduciary duties of investors. On the other hand, you have regulators claiming that the claims of environmental or social or governmental benefits are really not there, and that some managers and investors who are selling their investments are not really living up to what they're claiming in terms of the good that they promised to do the world. So can you comment a bit on those two issues? One is, I think one of our questions went to greenwashing, which would be perhaps in the second category, and then the other is the question of fiduciary duties. So we're kind of ping-ponging between various criticisms in this field. How would you address those?
So I firstly, I'm not a lawyer, but lawyers that I do work with would have and do tell me that there is nothing inconsistent with fiduciary duty in considering things that we believe are likely to be financially material, just because they happen to be about water, as Jacqui mentioned, or about diversity, right? That is, in fact, I would argue, you would be disappointing your clients, right? If those potentially financial material issues were not part of your analysis. And indeed, I was looking at the prospectus disclosures of a fund that's out there offering itself on the anti-ESG side, and it discloses that it ignores climate risks because it has to tell its clients that it is in fact ignoring something that could be financially material, right? So I think the argument about fiduciary duty, I think is a bit of a red herring that's been put out by people. Obviously, if you are investing for impact and you are looking at other outcomes, that is a different conversation, right? And that's appropriate if a client has decided to do that and they know what they're doing. So the important thing is to be very clear, just as we are today, about what it is that you are doing. One of the challenges is that because the ESG investing space has evolved quite a lot over the last couple of decades, the regulatory framework and the naming rules and the terminology haven't yet settled down. And so in some markets, like Europe, and also in Hong Kong and Singapore and Australia, the regulators are creating clearer categories to make it clear when you're investing for impact, when you're investing for ESG investing. And the SEC has consulted on a similar set of naming conventions. I would expect that sometime early next year, we may see the outcome of that. And so I think that will help because even if the definitions are not perfect, it will at least allow everybody to be clear about what they are selecting when they choose an ESG investing product or an impact product, and that those are really two different things.
And possibly giving more comfort to investors, which could enhance interest in the field, I would imagine.
I think that's right. And one of the things that we've seen is that the demand from our clients has grown in the US quite substantially over the last 2 or 3 years for a range of different solutions. Now over half of the due diligence questionnaires and requests for proposals that we receive in North America are asking specifically about how we consider ESG. And that includes a lot of clients who 10 years ago had invested in a strategy, never asked about ESG, but now they expect financially material ESG analysis to be taking place. And that's a shift in mindset. And I think there's still more to come. If I compare it to Europe, where that number would be 80 or 90%, right? So there's still more opportunity. But the good news is that there are plenty of examples, I'm sure we'll come to later, of where that financially material analysis can really help in your investment performance. And so I think that has come through, and that's why people are asking about it.
Great. Well, before we leave the issue of fiduciary duty, one of our audience asked a question about how CPG balances its responsibility to our retirees with kind of doing good through investing. So when we mentioned impact investing at CPG, because we are a heavily regulated pension fund and really have to put the performance of the fund first, when we do impact investing, we demand of ourselves that any impact investment has at least the same risk reward possibilities or potential that any other investment and with a similar risk reward profile would have. So that does narrow you talked about the funnel, Jonathan, that does narrow the funnel considerably. Sometimes you could say we're looking for the needles in the haystack, but we demand of our investment that they produce the returns that we legally have to produce to support our retirees, which is our principal mission as an organization. But nevertheless, we've managed to come up with some exceedingly interesting and impressive and impactful investments through the years. And we talk about those in other of these panels that we have had. So I want to turn to the mining industry, Jacqui. That industry has been heavily criticized from a variety of sectors as being very dirty. And it can be, I'm sure, by its nature. But on the other hand, mining is necessary to extract metals and minerals that are absolutely necessary for the clean energy transition. So it's one has to be nuanced in its assessment. And you mentioned water and biodiversity and such, but talk to us a little bit about those and some of the other issues that come up from an ESG perspective as you're considering mining investments for your firm.
Sure, and thank you for highlighting, mining is required for clean energy transition, and more and astonishingly more minerals will be required for that to occur. The sort of projections that we have on the requirement for particular critical minerals for the renewable energy markets, this is a significant challenge for the industry to meet the demand for those minerals. And it is mining, it's the capital investment in mining that will deliver those clean energy transition goals. So I think it's important to make that link that you need mining to achieve that. And I think when we talk about mining being a dirty business, I think there's a lot of perceptions that are dated or misinformation or a reputation that comes from some big events that occur and obviously hit quite a lot of media because single events that are quite horrible outcomes. The truth is that there are many individual companies and the wider industry as a whole that is rapidly evolving with the growing demands of ESG from stakeholders. And when we talk to fiduciary duty, if I think about it from a mining perspective, and I have it on my own fund, investing in mining companies, and then I also sit as a director of multiple mining companies. From my investment perspective in mining, doing ESG well is actually good business. It's good for the investment. And if you think when I invest in a project, I'm then looking to sell it to someone else in 4 to 5 years' time. And what I'm looking to maximize value is to ensure the maximum suite of investors, of people that will be interested in that project, are there. And that's why we'll get maximum value for it. And the reality is that in my world, what I see, the suite of investors that care about ESG is far larger than the ones that don't. And so we do this because we want to do this, but we also do this because it does satisfy our fiduciary duty as well to maximize value. From a director of a mining company's perspective, when I'm on the board, ESG is one of the biggest things I drive, and I use my firm's support to help add resources. And really it's the same story, one more level closer to the mine, is if we don't get this right, we will have issues that will stop us mining. It will become financial. And so I think when I see that it's separated from financial, at least in the mining world, I can't comprehend that there is no longer the case that you can just mine and not care about ESG. You won't be in business for very long. And so that's sort of my perspective on it. I think in terms of issues, I touched on them before, that it's very specific. I think the global trends that you think of in terms of diversity, equity, and inclusion, you talk about carbon emissions, Indigenous relations, water and biodiversity. Those big themes, they all come to play in mining as issues that we need to think about when we're looking at a potential investment. And every mine will have some aspect of those that we will look at. And there is the risk, there's also the opportunity. So there's the real opportunity to go in and add value with what we're doing in that area. And I know that we've you hear a lot in the mining industry of the term social license to operate. I think I was having a conversation with Christopher a couple of weeks ago and mentioned that, you know, that term has now morphed into privilege to operate. It's not a license that you get and that you get to keep. I think having another conversation internally recently with our ESG experts, it's more, he highlighted to me that no community celebrated a mining company getting a social license, right? They celebrate actually social value being delivered to them. And so as time goes by, as the demands of the world on companies evolves, the mining industry is evolving as well and evolving with it and rapidly improving. And I think, you know, back to my first point, we need it to deliver the sustainable development goals that the world is seeking.
Great, thank you.
Jacqui,
Very encouraging message.
we have a question that came in from the audience. I'm curious if we could respond. And so as you look at opportunities globally in different regions of the world with different ESG considerations in different regions, the individual was asking, how do you manage consistency of comparing, you know, an opportunity in one part of the world with an opportunity in another? How do you compare different investments?
Yeah. Yeah, good question. Good question. And there's a lot that goes into thinking about that, because geopolitical risk is a significant factor to consider for us. And the world's mines are not necessarily located in great jurisdictions, in great areas to do it, and in areas that won't impact. But think about how we manage risk. So we think the hierarchy of managing ESG impacts is, think about avoid, mitigate, compensate. So can you avoid impacting first? Can you avoid? If there's no avoidance of it, can you mitigate what you're doing, and ultimately compensation? And I think if we think about how do we assess across different situations, different jurisdictions, different impacts on communities, on the environment, I think we're bringing it back to where are we in that hierarchy? Clearly, it'll be a different aspect of every bit that we're looking at, but where we're at in terms of this, is this an investment where we can predominantly avoid and mitigate, or is this an investment that will have a significant impact, and our only option is to compensate? And then clearly there's a ranking that, yeah, I'm sure even you can understand. If you haven't done mining investment, you can still understand there's a ranking there that helps us assess this, and particularly when we're talking about those factors that are not so easy to put into a financial model.
Thank you. You know, all of you have kind of touched on or alluded to the fact that there's been an evolution in this area. So how do you, part of this was on the regulatory front, but how do you think about what's happened in, say, the last 5 years, if not 10 years, in terms of focus on ESG, opportunities for ESG to have an impact? It seems to me that the change has been pretty rapid, but what do you all think?
I'm happy to start. It's absolutely a fast-paced environment. And the good news is that it allows many more sophisticated tools for investors to bring to bear as they're seeking to build out sustainable and ESG-oriented portfolios. And as we think about, the sort of growing and changing landscape, while it is a huge benefit, I think there also just creates some challenges or some hurdles to adoption, as we're working with, different U.S. investors who are, to the earlier question, trying to make heads or tails of, now this space covers a lot of different tools. All of those tools may have different objectives. Different portfolios may have different, return expectations, different risk management, budgets and appetites. So how do we, as investors, sort of navigate this evolving space? I think just in Q1 alone, there were, maybe 20 to 25 new sustainable pooled funds that came to market in the United States. And so the hurdle really becomes due diligence and education, and understanding how to define, what you think about from a sustainability perspective, what is most important for you and your organization. And Mary Kate, I think what you were saying earlier is a really incredibly important point, because we're not making decisions about what we want to do from a sustainability perspective in isolation. We have to root those elements in the holistic understanding of what are the expectations of this investment portfolio? What is the risk appetite? What is the investment style that we're most comfortable with? How do we think about adopting a sustainability strategy or integrating ESG in that approach in a way that's both meaningful, but also fits within those parameters and guidelines? So I think that's what I see as the biggest, sort of change over the past few years, is just this, sort of flood of information, of tools, of analytics, of investment offerings. And we see so many more investors looking to get into this space, but also looking for guidance and looking for, sort of a sounding board to help them understand and think through, how do we crystallize those elements that are most important for us.
Well, and you're just responding to a question that one of our audience put in, saying that they're trying to do something with their own church portfolio and finding this whole area to be confusing and fuzzy. And as some of you have said before, this is evolving. And as you just pointed out, Emily, lots of options flooding into the market, and it's difficult to kind of choose and to understand them. So others on the evolution of this, the rapid evolution of ESG interest?
Maybe I just add one thing. So, part of it is also what's happening in the real world, right? The evolution that we as consumers, as people who are making decisions about where we want to work and how we want to use our free time, we are making different choices. We now have social media for its benefits or lack of them. We can now see what's happening to Indigenous communities in the neighborhoods of the mines that Jacqui was talking about. We can understand some of the challenges in supply chains for the goods that we purchase. We understand if someone's working at a video gaming company and there are allegations of discrimination and harassment, right? That becomes much more visible than was the case a couple of decades ago. And so the materiality of these topics has shifted, and our expectations as consumers and as citizens have also evolved with that. And at the same time, the planet is, seeing the implications of physical climate change. And we are becoming much more aware of the way that biodiversity sustains us and yet is under threat. So the environment around us, I would argue, is more complex. We have more visibility. We're making more decisions as individuals. And so that is having an impact on which companies thrive, which companies struggle. And hence, as investors, we have to think about more things. You know, we have a very successful and long tenured partner at our firm who's been with us for over 5 decades. And you know, there was a time when you could pick stocks based on looking at the New York Times. That doesn't work. And so now we have to have a much more complex set of information in order to deliver for clients.
Indeed, and you're right to raise the issue of social media, which kind of many multiples of the information that was available before, and how to sift through and make sense of all of that as well, for better or worse. So excellent point.
And if I could add, Mary Kate, sorry, just to interject, I do want to underscore that there are also more resources out there to help navigate this space. That's another benefit. So as we're seeing this become, a bit of an alphabet soup of the ABCs of ESG, that there are more organizations that have pulled together materials to help educate and help provide guidance. We did write a piece earlier this year that's focused on jumping the hurdles. How do we define the steps in the process for organizations who are going down that original pathway and trying to think through what is our investment philosophy and how do we adapt it or enhance it to bring sustainability objectives into account. And I know there are many more organizations out there that are putting together thought leadership or practices to help guide that process.
Well, that's an excellent segue, and we want to leave a few minutes for more questions from the audience, but this is a topic I wanted to cover, which is, I mean, we have a large pot of assets and run a pension fund, which has, a plethora of regulations that govern us and such, so very differently situated than some parish investor, people who are investing parish money, or people who are individuals who want to get into this field. So anything you all can say about advice, and you've just started down that path, Emily, advice to those who are not a large pension fund like we are, but are, people who want to jump in and use their portfolios to do good in the world and see ESG as a possible, as something they need to get their arms around and kind of perhaps jump on the bandwagon with.
I think this is a great first step, right? Finding the resources that are available to help provide that education and help provide the lexicon so that you can start to ask the right questions and start to inform yourselves or have a more informed dialogue amongst the decision makers. I think that's a really important first step. As you look at resources available, I mentioned we wrote a paper, it's out there in the public sphere, but there are a variety of resources out there, asset managers, brokerage platforms, different membership organizations like the Principles for Responsible Investing or Ceres or US SIF. These are international or US-based organizations that are specifically focused on driving education and adoption for sustainable investing, and have a great many resources out there.
I'm wondering if someone on our team could possibly put some of those names in the chat, and maybe even a link to your Northern Trust materials, Emily. I'm sure
I think that's a great idea, because having access to that sort of information can help inform the conversation. But I also think, as we think through the steps of the sort of education through implementation process, I think firstly it is setting out some clear expectations. What are the objectives that we want to achieve? Investment and sustainability. How do we then use those objectives to guide our thinking as we ask questions of the managers, right? Doing some due diligence on the capabilities that are out there, or digging into the ways that managers are voting their proxies or engaging on our behalf. So really starting to get a good sense of what your service providers are doing on your behalf already, and what they could be doing, so that then can inform how you want to proceed, so you can make more informed, thoughtful decisions.
I guess the one thing I would add to this conversation of where to start and how to proceed, some of this can be very daunting. And one of the observations I've made is that this is highly nuanced, highly complex, and there aren't always easy answers. So those that would suppose that there are easy answers probably aren't giving you good advice. Those that are willing to sit down with you, talk with you, inform you, educate you, question you, those are the kinds of partners that you would want to work with as you start to explore. The other piece that I would just encourage anybody who wants to take a step in this is don't let perfect be the enemy of the good. Start somewhere, work your way in. You'll make mistakes, but keep going. And as you do, I think you'll develop a very successful investment program like we have at CPG.
Thank you, Christopher. Should we spend the last few minutes going to some of the questions that have been raised by our audience? Been a very lively audience, so grateful for that.
Yep. So one question, we touched on it, but I don't know if there's something in more detail. There's a question around greenwashing. So for the good of the group, could someone define what you believe to be greenwashing, and how do investors identify cases of greenwashing? Could you sort of explore that topic? Who wants to grab that?
Sure, I'm happy to start. So I mean, the idea is that misleading sales, right? That's basically the concept, and it could be by a company. So you could say this large oil and gas company is running advertisements talking about its investments in a low carbon technology, but that represents a tiny percent of the capital expenditure each year, and is not potentially, I might argue, a serious undertaking. And in fact, that literally has happened in a few cases where there have been legal cases around such advertising. So that's a form of greenwashing, where you attempt to make the company look more sustainable or environmentally friendly. The same allegation could be made against an investment product, right? If the investment product has the word ESG in or sustainable, and you find that it owns some of those less responsibly managed companies with poor environmental practices, then that could allegedly be greenwashing by an investment manager. And so that's where you want to make sure that you're asking the questions and you're reading the offering documents to be clear what it is that is being offered. So if it says it's a climate transition strategy and yet it can invest in coal, you're going to want to ask, okay, how does that work? Maybe that is fine, but maybe that's not what you thought you were getting. So there have been some investigations and some cases around this, and obviously it's something that I think all good investment managers are trying very carefully to make sure that they're clear what their investment products do and what they don't do, just as corporates are now probably being even more sensitive. So the main thing is, don't just buy it on the basis of what's in the name. Make sure you're reading the materials and you're asking the question as to, okay, so what does ESG mean in this process? What does sustainability mean in this process? And that'll help you to avoid unintentional greenwashing.
And I would add, we're seeing an uptick in questions not just about how does sustainability feature in this investment vehicle or this fund, but also how are you as an investment manager embracing sustainability across your practice? And that's a really interesting question, right? As you're thinking about embracing your commitment and your values around sustainability across the value chain, how are you running due diligence, not just on a given strategy, but also on the ways that it's, we talked about voting and engagement, right? The stewardship that's being done on behalf of the portfolio, the way that the investment management firm is working to reduce their carbon footprint and their operational carbon emissions, the way that they are seeking to foster a more diverse, equitable, and inclusive workforce, or working to build a more thoughtful approach to managing the downside impacts through their supply chain and their service providers, right? I'm seeing a significant uptick in those sorts of questions to our practice, where we're seeing investors really want to partner with organizations, not just for the the sustainability objectives of the vehicle they're invested in, but also the high level commitment and philosophy of the investment manager on the whole.
I'll just add briefly, I think it's sort of a question of how do you spot it? I think for me, I look at greenwashing at a particular company level, and for me, I see greenwashing if we only see the good news and we don't see the bad. So it could be that everything you're reading of what they do in ESG is true, it's good, it's factual, it just happens to be only the good news. And I think assessing if a company is genuinely committed, they will be open about mistakes they make and where things are not so good. And that is, I think, when you read reports, when you listen to their quarterly updates where they talk to analysts, a lot of them, sometimes you can get those and you can listen in when they deliver their results. Do they talk about their safety statistics? Do they talk about, and are they open about when they're not satisfied with their own performance? And to me, that's the opposite of greenwashing, is when someone is prepared to say when they haven't done as good as they hoped, and here's what they want to do better going forward. And then that is someone that I'd prefer to put my money behind. So that's how I look at it from a company by company perspective.
Yeah, that's a terrific point. And as some noted earlier, the regulators, SEC and otherwise, are getting kind of more attuned to these issues. And over time, I guess there'll be more specific disclosure requirements and such, which will make people's jobs easier. But that's a field that's still evolving. So one person asked, and I think this might have to be our last point, but Christopher, one person asked about real estate investing and how ESG concepts can be incorporated in real estate investing, which triggered to me the work that we had done and with some of our real estate investors and getting them focused on ESG. Do you want to just close out with that quick story? And then I'm going to have to thank everybody and end on time.
I'd love to share. And so I have to give Alan Snoddy, who at the time was our head of real estate, and he's passionate about ESG and understanding where and how our managers incorporate ESG into their investment analysis. And so as part of our duty to understand how our managers operate, we sent out a survey to all of our managers to ask them about 20 or 30 questions related to how they consider ESG issues in the investments that they make on behalf of the fund. As a follow-on to that, then we had a meeting where we brought all of those that responded to the survey together for dialogue to really sort of collectively understand where were their issues, where was their potential growth, and where could we make progress. And anecdotally, some of the managers have come back to us and said, this was a really valuable conversation, and it's informed our process going forward. That is a highlight in terms of how we've worked with ESG our managers. I mean, and then the real estate issues that you might consider are very complex in terms of what's material, ranging from climate change, water scarcity, water usage, building materials. And these are the kinds of questions that we engaged with when we had that conference with the managers.
Thank you. Well, we are out of time, and I am beyond for all of you busy people who have brought your expertise to bear today. This has been a great conversation. I wish we had another hour to continue, because I have at least double the number of questions I've already asked, but it's the end of our time. And thank you. And thank you to our audience for joining us and being so engaged. We much appreciate your attention and presence today. Everyone have a great afternoon, and Jacqui, good night.
Thank you.
Thank you.